There's a financial market almost no one understands, yet it literally controls everything. Not the stock market, not the real estate market, but the bond market. If you don't grasp bonds, how they work, and why they're so powerful, then you don't truly understand money. You won't understand how governments finance their spending, how interest rates are determined, or why stock markets rise and fall. Because everything, absolutely everything, in modern finance is tied to bonds. Mortgage rates are determined by bonds, car loan rates by bonds, government budgets are financed by bonds, and pensions are heavily invested in bonds. Central banks buy and sell bonds to control the economy. The bond market is the backbone of the global financial system, larger in size and often more influential than the stock market. And yet, almost no one pays attention to it. Everyone watches stocks, but true investors watch bonds, because bonds don't just reflect the economy, they actively shape it. Welcome to Economic Awakening, where we decode the hidden forces shaping our financial world. Here's what almost no one realizes. The global bond market is worth approximately 130 trillion US dollars. The global stock market is around 100 trillion. Bonds are larger, and they are far more critical to the daily functioning of the economy because governments rely heavily on bonds to finance spending when tax revenues fall short. This borrowing creates budget deficits and contributes to national debt. For instance, the United States finances a significant portion of its expenditures through treasury bonds. Every time the U.S. government spends more than it collects in taxes, it issues bonds. Investors buy these bonds, the government gets cash, and it promises to repay with interest. This is how the 36 trillion US dollar debt was created, bond after bond, year after year. And now, the bond market effectively controls what the government can do, because if investors stop buying bonds, the government cannot finance its operations. I'm a bond market analyst, and I've spent 15 years studying how bonds drive the global economy. What I'm about to explain today is the single most important concept for understanding modern finance. Without understanding bonds, you cannot truly grasp how money works, how interest rates are set, how governments finance wars and social programs, or how central banks control inflation. It all comes back to bonds. In this video, you will discover exactly what bonds are and how they function. You'll understand the critical inverse relationship between bond prices and yields, and you'll learn why the bond market actively shapes the economy rather than merely reflecting it. Stay until the end, because I will reveal how to monitor the bond market to predict economic movements before they happen. Let's start with the basics. At its core, a bond is a loan. Investors lend money to governments or corporations, and in return, they receive regular interest payments plus the original amount back on a fixed date. It's simple. You buy a bond, you lend money, the borrower pays you interest, and at the end, they repay your original money. Here's a concrete example. The US government issues a 1,000 US dollar bond with a 5% coupon and a 10-year maturity. You buy this bond for 1,000 US dollars. Each year for 10 years, the government pays you 50 US dollars in interest, 5% of 1,000. After 10 years, the government repays your original 1,000 US dollars. You've earned 500 US dollars in total interest over 10 years. Plus, you get your principal back. Every bond has three key components. The principal, which is the amount borrowed, in our example, 1,000 US dollars. The coupon, which is the interest rate paid to investors, in our example, 5%. And the maturity, which is the date when the principal is repaid, in our example, 10 years. These three components define every bond. Now here's where it gets interesting. Once issued, bonds are traded on markets, and their prices constantly change. This leads to one of the most important relationships in finance. Bond prices and yields move in opposite directions. When prices fall, yields rise. When prices rise, yields fall. Here's why this is so critical. Imagine you own that 1,000 US dollar bond paying 50 US dollars a year, which is a 5% yield. Now, market interest rates rise. New bonds are being issued at 6%. Suddenly, your 5% bond doesn't look as attractive. Who wants 5% when they can get 6% with new bonds? So, if you want to sell your bond, you have to lower the price. Perhaps you sell it for 900 US dollars. The buyer pays 900, but they still receive 50 US dollars a year. Now, 50 divided by 900 is approximately a 5.5% yield. Better, but still not as good as the new bonds at 6%. The bond price falls, the yield rises. It's an inverse relationship. It's mathematical, and it's absolutely fundamental to understanding how the bond market works. If you're starting to see how bond prices and yields move inversely and why that's important, then subscribe to this channel now and activate notifications, because what I'm going to show you next is how bonds are actually created and traded. There are two main layers to this system: the primary market and the secondary market. In the primary market, new bonds are issued, often through auctions that set the initial interest rates. Here's how it works. The US government decides it needs to borrow 10 billion US dollars. It announces a bond auction. Investors from around the world submit bids. I'll buy 100 million at a 4% yield. I'll buy 50 million at a 3.9% yield. The government accepts bids starting with the lowest yield until it is sold 10 billion. The highest accepted yield becomes the coupon rate for everyone. That's the primary market, the creation of new bonds. In the secondary market, investors trade existing bonds, and prices change based on expectations around inflation, interest rates, and economic conditions. This is where bonds are bought and sold after initial issuance, and it's where prices constantly move. If investors think inflation will rise, they sell bonds, prices fall, and yields rise. Why? Because inflation erodes the value of fixed interest payments. If you receive 50 US dollars a year, but inflation is at 5%, those 50 US dollars are worth less each year in real purchasing power. So investors demand higher yields to compensate. If investors think the economy will slow down, they buy bonds, prices rise, and yields fall. Why? Because during recessions, stocks become risky. Bonds, especially government bonds, are perceived as safe. So demand rises, prices rise, and yields fall. The secondary market and all its prices reflect the collective expectations of millions of investors about inflation, growth, and risk. And these prices, these yields, drive everything else in the economy. Now, let's understand how bond yields impact the broader economy. Bond yields have a powerful impact on the broader economy. When yields rise, borrowing becomes more expensive for governments, businesses, and consumers. This can slow economic growth. Here's the chain of causality. Government bond yields rise. Let's say 10-year US Treasury bond yields go from 3% to 5%. Now, mortgages are tied to bond yields. If bond yields rise, mortgage rates climb from 4% to 6%. Suddenly, buying a house becomes much more expensive. Housing demand drops. Real estate prices stagnate or fall. Construction slows down. Construction jobs are lost. The economy slows. Car loans are linked to bond yields. Yields rise, auto loan rates rise. Buying a car becomes more expensive. Car sales drop. Automakers lay off workers. The economy slows. Companies borrow by issuing corporate bonds. If government yields rise, corporate yields also rise. Borrowing for expansion becomes expensive. Companies postpone investments. Growth slows. Hiring slows. The economy slows. Rising bond yields act as a brake on the entire economy. This is why central banks obsessively monitor bond yields, because they effectively control how much borrowing costs across the economy. Higher yields also create competition for stocks. If bonds offer better returns with lower risk, investors may shift money away from stocks. Here's the math. Stocks historically offer about 10% annual returns long-term, but with a lot of volatility and risk. If bonds offer 3%, stocks seem attractive, 10% versus 3%. You take the extra risk for 7% additional return. But if bonds offer 6%, the decision changes. 10% versus 6%. Only 4% additional return for a lot more risk. Suddenly, bonds look better. Investors sell stocks, buy bonds. The stock market falls. This is why rising bond yields often cause stock market corrections, not because the economy is bad, but because bonds become relatively more attractive. Because of all this, the bond market doesn't just reflect the economy, it actively shapes it, influencing everything from interest rates and inflation to stock market performance and global capital flows. Here are concrete examples. In 2022, bond yields exploded from 1% to 5%. Why? Inflation. Investors demanded higher yields to compensate. The result? Mortgage rates doubled, housing collapsed, stocks plunged by 20%. A recession almost arrived, all driven by rising bond yields. In 2008, during the financial crisis, bond yields plummeted toward zero. Why? A flight to safety. Everyone was buying government bonds. Prices rose, yields fell. The Federal Reserve even pushed rates to zero. Borrowing became almost free. This allowed the government and companies to finance massively to stimulate the economy. The recovery was financed by low-yield bonds. The bond market drives economic cycles: boom, bust, recovery, all visible in bond yields if you know where to look. Now, here's how to monitor the bond market to predict economic movements. Watch the yield curve. This is a graph showing bond yields across different maturities: short-term, medium-term, long-term. Normally, the curve slopes upward. Long-term bonds yield more than short-term bonds because there's more risk in lending for 30 years than for 2 years. But sometimes the curve inverts. Short-term bonds yield more than long-term bonds. This typically signals an upcoming recession. Why? Because investors believe the Federal Reserve will cut rates soon to combat a recession. So, long-term yields fall in anticipation, while short-term yields remain high because the Fed hasn't cut yet. An inverted curve has preceded almost every recession for the past 50 years. It's the most reliable warning signal. Monitor credit spreads, which are the difference between corporate bond yields and government bond yields. If spreads widen, it means investors perceive more risk in companies. They demand more yield to compensate. Widening spreads often signal impending economic stress. Watch central bank purchases. When the Federal Reserve massively buys bonds, quantitative easing, it pushes yields down. This stimulates the economy. When the Fed sells or stops buying, quantitative tightening, yields rise. This slows the economy. Follow what the Fed does with bonds. It predicts where the economy is headed. Here are the 3 final truths you must understand. First truth: bonds are more important than stocks for understanding the economy. Stocks reflect corporate profits. Bonds reflect expectations of interest rates, inflation, and growth for the entire economy. If you want to understand where the economy is going, look at bonds. Second truth: bond yields drive almost everything. Mortgages, car loans, corporate loans, stock market valuations. Everything is tied to bond yields. When yields move, everything else follows. This is why professionals obsessively monitor bonds. Third truth: understanding the inverse price-yield relationship is fundamental. Price falls, yield rises. Price rises, yield falls. If you don't understand this, you don't understand bonds. And if you don't understand bonds, you don't understand money. If this exploration of bonds has revealed why they are more important than stocks for understanding the economy, if you now see how bond yields drive everything, then subscribe to this channel now, activate all notifications, and share this video. Let me know in the comments, did you understand bonds before this video? How does this change your understanding of the economy? I read all your comments and engage with them. Thank you for joining me in this exploration of bonds. Remember, bonds are not boring. They are the heart of the financial system. They determine interest rates, drive economic cycles, and shape everything from real estate to stocks. Understand bonds, and you truly understand how money works. See you very soon.